Investment Committee of Carterton District Council. Order of business today, we'll open with the karakia timatanga, and I shall lead that off. Mai te pai manga, raro ki te tai. Mai te awa tonga, raro ki te awa raki. Tēnei te hapori, awhi ai I taratahi, whano, haramai te toki, humi hui taiki. Okay, there are no apologies received. Are there any conflicts of interest that anybody would like to declare at this point? There being none, there is no public forum, so we're able to go straight to reports. I meant to welcome everybody here, particularly Peter Verhart from Ericsson Global. Okay, let's get into the reports. Page 6, the investment update report. Who's taking us through that? Kelly.
Yep,
thank you.
So this is the first time we've presented this report to the first committee meeting. So what we've tried to do is give a bit of background about how we got to this point with the committee, decisions that have been made to now around the SIPO, and council's current investment position, as well as considering also where we're heading from here. So I suppose highlighters, we have $3 million invested in managed funds currently. The decision was made to do that last year. So we have an update on the performance of the funds, but just noting that those were only invested October, November last year. So it is quite soon to, I guess, comment on the overall performance of those funds, given it hasn't been a whole lot of time to now. And I'm sure Peter may like to comment shortly. But the other part I will flag just as the next step. So the council had approved last year for further investment before 30th of June of up to $2 million. So the recommendation by officers at this point is to just hold off on that while we do some further work around our cash flow and the capital program for the remainder of the year. And then we will plan to do some more cash flow forecasting to bring to the main meeting for further discussion with the committee before we do proceed with making further investment. So I'll leave it there.
Thank you. Could I make a comment? We would also look to our investment advisor, Ericsson's, to if we come with a recommendation for further investment, we would also look to Ericsson's as to what that investment recommendation should be and where we should put those funds, and we would hope to bring that back into the main meeting, with that advice. So it wouldn't just be an investment; it would be an investment in these particular managed funds or recommendations. Yeah.
And can I just add as well, being the first paper, really happy to take on board feedback from the committee if there is anything else you would like to see in the future.
Okay, everybody, your opportunity to raise questions. Does anybody have anything they want to ask Kelly or Jeff or Peter?
There's a couple of things that struck me. One was the issue of taxation around managed funds, and we don't pay tax as a council. But I had a little bit of background on managed funds. Most of them do pay tax.
I can take that, Jeff, if you like.
Yeah, sure.
So these funds are essentially, the two funds, Castle Point and the Harbour Fund, are portfolio investment entities, PIEs.
Okay. Yeah.
So effectively, each investor provides their own tax rate, their prescribed investor rate, and one of the rates that you can give is 0.
Right.
So essentially, it will pass gross income through to the investor and pay no tax on the way through. There's a little bit of tax slippage involved, but that's more because you don't pay tax yourselves rather than the fund. In the way that they're managing. So things like foreign tax credits, you can offset against tax that you pay. But if you don't pay tax, then there's nothing to offset. But of course, not paying tax is an advantage over a taxpayer. So, it's just the ground that you come with for that.
Thank you, Peter.
So these are tax efficient, basically.
Right, okay. I was a little bit surprised at the private equity fund. It seems, I don't know if I put my money in it. The two issues, it's quite small. So we've got 2 million out of, or $1 million out of 45 million. So, and I just worry about the liquidity of those investments and relatively small unlisted equities. So,
Yeah, no, that's a really good question. So first of all, the Castle Point and Harbour funds are extremely liquid. I mean, you can get all your money out in essentially the trading day plus 2 days after that. So 3 days essentially. The Castle Rock Fund is a little different from a lot of other private equity funds that you may have come across, in that it actually does have liquidity events throughout the year, quarterly, where you can actually pull some money out. And they manage that through the quite large amount of income that's coming out of the fund, but also through debt provisions that they have. So even though it's more liquid than the other two investments, it certainly is more liquid than your standard private equity funds. The reason they can do that is that they invest in existing companies that are, turning out cash, rather than companies in early stages that need development and essentially growing. So it is if you like, it's an income type of private equity fund.
okay.
Thank you, Peter. Steve, have you got any more?
Well, just this is just kind of about how we're structured, really. I mean, we the other day we decided not to appoint an independent chair on the basis that the field of people who put their hand in is quite small. I just wonder what, in fact, the cost of the independent chair would be relative to the size of our investment fund and whether it's actually necessary.
That's a really, really good point. The offer was for an independent chair, so we offered about the same as the chair. So I think we had $170 an hour in terms of remuneration.
Right.
Peter may have a better idea, but I'd expect an independent chair at investment committee would, we're in the 10 to 15, maybe $25,000 range, depending on the size of your portfolio. So you're absolutely right. A $3 to $7 million or $3 to $10 million portfolio, it's quite a big cost for that portfolio. I've got a great deal of confidence in Ericsson's. I've also probably got a bit of background, so I'm relatively confident, but it's not about me, it's about the governance group having confidence in the ability for the committee to understand the risks and manage those risks outside of management and the CEO.
Yeah.
So as long as the governance group are comfortable with proceeding, that's the key decision.
Yeah. Until we've got, over 10, my inclination would be to say that we should soldier on, but that's not a fault for us. I guess that's for the whole council.
Yeah, but I would imagine what we would do is once we've got our knees under the table and comfortable with the structure and the process that we've got and the personnel around the table, we would make a recommendation back to council one way or the other.
Yeah.
At that point, I tend to agree with you, and in fact, probably given all the experience around the table, there are probably sufficient expertise to be able to govern a portfolio of this size pretty comfortably, providing we maintain the independence through Ericsson Global.
Yeah, I wouldn't advocate it otherwise.
Yeah. Yeah. But anyway, we can have that conversation. Anyway, it's a good point.
Peter, I wonder if I might give you the opportunity to talk through your report, which is very comprehensive and informative, and whilst you're doing that, I'm going to ask a leading question about bonds. You probably know where my question's going is, the bond market has been bashed recently with inflation expectations and hiking of interest rates. So my question really is, you know, at some point in the near future, you'd expect that bonds would be quite a good investment as the economy turns to recession, and there's the possibility of capital gain on bonds. And I wonder if, you know, that is something that this committee should consider, or if we consider it through a different managed fund like Milford Active or something. But yeah, perhaps you could take us through your report. So I think I always find them very informative.
Yeah, thanks, Jeff. I mean, today's quite an exciting day, right? Because we've just seen the official cash rate go up 50 basis points, or 0.5%. So that's taken it up to 4.75% now, on the basis of you know, Reserve Bank saying that inflation is sticky, and even though the rate hike that happened today was widely anticipated by, you know, almost everybody in the market, if not everybody, the one thing that has changed is that they've pushed out their expectation for when their, you know, last possible hike could be, to the end of the year. So yeah, a little more reserved than before, and that's obviously will affect people's views on how long this inflation issue is going to be around for. In terms of bonds, well, bonds have taken an absolute hammering in 2022 as interest rates go up, because you lose money from bonds when interest rates go up to an effect that it you know, nets out the amount of income you're making out of it. But eventually you get to the point where the interest rates have gone up so much, you've actually got quite a nice looking investment going forward. The best way to manage it, in our view, is to appoint active investment managers to actually look for opportunities in the market and build a portfolio that's going to be resilient going forward, resilient to, you know, market shocks. I mean, we've seen the correlation, if you like, between equities and bonds on a breakdown over the last year or so. In other words, they both went down together, which is pretty unusual. That we expect to come back to a more normal level. I mean, whatever normal means in this market, and so, you know, that can cushion the effect in terms of if we have further equity weakness, which we are expecting to happen going forward. And if you have a look at something like the Harbour Income Fund that you're in, the running yield on that, or the yield to maturity, is about 5.25%. So, you know, it's a good return that's sitting there just from sitting on the bonds that are in the portfolio. So yeah, bonds are looking good again, looking forward. Equities probably still have a little way to go, and it'll be a wait and watch for equities to see where inflation goes and what's happening with Russia and Ukraine and China and the US and these sorts of aspects as we go through. Fair to say valuations on equities have come down a lot. They were looking extremely expensive there for a long time. We have had quite a significant correction in equities, probably too early to call the end of that, but it's certainly sitting in a better place than it was before. The other thing I'll say too is that we have a mix of different ways of managing equities or shares in your portfolios. So if you have a look at the way, say, that Castle Point is looking after them, they had a strategy in their fund called a low volatility strategy. So it's looking at those lower risk type shares in the portfolio, and that certainly paid off for them in 2022. They also have some downside protection strategies in that fund as well, to cushion that sort of blow. So if I just have a look at the report, I mean, Kelly hit the nail on the head. This is 2 months into a long-term investment cycle. So none of the funds that we've put in here are aiming to you know, create short-term returns for the portfolio. You have you know, a diversified portfolio of term deposits for that benefit, and certainly the returns on term deposits are looking a hell of a lot better than they were, you know, a couple of years ago. So I'll just touch on some of the items in this report. And, you know, as Kelly mentioned, we're really keen to get some feedback on the format of this and make sure that it meets everybody's needs. So the first thing that will hit you is that chart was essentially showing the performance of the portfolio relative to the long-term objective. That is a long-term objective. It's based on inflation. So you can imagine right now that it's a very difficult thing to achieve given where inflation rates are. I mean, New Zealand's sitting at 7.2%, although this is averaged over 3-year time horizons. So as at December, it was 4.8% was the average 3-year inflation return. And since getting invested, you're ahead. You've got a positive return. Actually, one thing I will do is give an accolade to the team for getting this money invested. So the SIPO was signed off on the 14th of September, and the portfolio was fully invested by the 4th of November. That's a real achievement to get through a fund manager's onboarding process, or 3 fund managers onboarding processes by that. So well done. What that means is that we got all the upside of November, and that cushioned the effect of December, which was down. If I was going to draw that again for January, it would be another spike up, with the return for Castle Point being around 1.8% and Harbour about 2.6%. For that particular month. Castle Rock, because of its nature, you'll get quarterly returns out of that. They distribute the last month of the quarter and also adjust their share price, or the price of fund rather, on a quarterly basis as well. But even the start for the Castle Rock portfolio has been positive. So they're distributing around about 10% per annum at the moment. And that has certainly, provided a good cash flow for the portfolio. We've elected to have that reinvested into the fund rather than receive as cash. And over December, that offset just a very small drop in the share price, largely due to one of the companies in the portfolio, Vivo Hair Salons, finding the economic climate a little bit difficult going at the moment. Which is another thing to look at, of course, is the horrific situation in the Hawke's Bay and around the country, in terms of the Gisborne region, in terms of the far north, and the effect that it could have on the incomes of the companies that are in some of these funds. Vivo is a good example. It's got a salon in Napier and also one in Havelock North. They're also right across the country. And but as long as they get their power back on, they've got cell phones. I'm sure a bit of pampering and time will be something that people of the Hawke's Bay will earn after the recent events. So, just having a look through, a lot of these say that it's too early to assess certain objectives like volatility and long-term return objectives, but we will be building this up over time. Actually, I should get your page numbers rather than mine. Just bear with me for a sec. So on page 14, you can see there that the chart there which just shows the recent month and since inception, which is 2 months. And it's a positive return. It's well behind the CPI objective, but as inflation gets more under control over time, that's when we'll look at achieving that one. At the moment, the positive step is making money, and we've certainly done that so far. So on page 15, you can see that there's different sections for recommendations. There's no recommendations because we've just made a whole suite that you've implemented. Manager updates, quite often things will change at the fund manager, whether it's a portfolio manager, whether it's a business. For example, Fisher Funds has just purchased Kiwi Wealth. Now, if Kiwi Wealth was one of your fund managers, obviously that would have an impact on the portfolio, and we will provide our view in terms of what action, if any, to take as a result of those sorts of changes. And I'm pleased to say nothing's changed over the last quarter for any of your funds. We give our outlook, and this is what you'll find that when you have Jonathan Erickson here, this is one of his favourite sections, and he's always great to listen to on this one. But it's it is a volatile time for markets, and we expect that to remain for some time. We're expecting the inflation to be sticky. The sticky seems to be the new buzzword for inflation. For a while there, it was transitory, but everybody realised that's no longer true. We are expecting the peak that the Reserve Bank is expecting in terms of the official cash rate in time, around the 5.5% mark. And that, of course, is hurting people that are paying off their mortgages and trying to get into new homes. But on the flip side, you've got people earning more from term deposits and so on. So more income for retirees. Ukraine, it just would be lovely to have a day where Putin's not on the front cover, but that just continues to escalate, certainly with Biden visiting Kiev the other day, and now Putin's doing more threats of nukes. It's something that obviously the markets get very jitterish about. Then there is a section on page 16 which just talks about the objective and also what the CPI numbers are, and a little bit about how these numbers in the reports are calculated. On 17, you can see the performance of each of the managers against their objectives. So that's just for the month shown there. And the further out we go there, the longer term those become relevant for comparing returns against objectives. We do comment in terms of what's happened in the portfolios over the month and quarter, in terms of the stocks that they're holding, in terms of the strategies that they're using, and in terms of income that gets distributed, particularly from the Castle Rock portfolio. So on page 19, there's a summary of the overall asset allocation. So it's still around a third to the fund managers. At the moment, the equation's pretty straightforward. You put $1 million in each of them. So if the number at the bottom is over 3 million, then you made money, and that's certainly the case. So that's been a solid start, particularly on how the markets have gone over that time period. On 20, there's a chart that does look pretty dull at the moment because it's comparing a position between 1 month and another month. Over time, you'll see that changing quite a bit as the underlying fund managers are changing their positions according to the market conditions. 21 is probably one of my favourite pages. This is the one that basically gives you all the numbers in terms of what's happening in the markets, or what's happened in the markets over the last month and quarter and year. There's some interesting abbreviations and acronyms and symbols here, and we can give you a rundown on some of those. For example, the MSCI World NR is the index for global equities, global shares. It's in local currency, so it's the return of what the US investor would get or the German investor would get. And the one below it is actually converted into New Zealand dollars. So comparing those two lines, you can see the effect that the currency has on the portfolio. And so, for example, over the 3 months, in local currency terms, the markets were up 7.5%, but because of the movement of the Kiwi dollar against major currencies, particularly the US in that particular time period, you end up with a negative return in New Zealand dollars. We always provide an economic commentary, which is hopefully interesting, entertaining. We always provide some topics as we go through here as well, just out of interest, but things that are going to be relevant in terms of the underlying investments. The one that a lot of people will have a look at is on 28, which is the market outlook. And here, essentially you would have heard that, past performance is no indicator of future performance, and absolutely that is spot on. There are certain things that you can look at in terms of market conditions and expectations for returns moving forward, but those expectations fit into certain bands. And out of that, we can actually say, well, what are we expecting looking forward? So an average return is more like an expected return that you get out of your portfolios. A good return is above expectations, and a bad return, it doesn't mean negative, it just means below expectations. Negative, of course, is part of that. So as you can see there is still quite a decent slug of red sitting in there, which is the which is the below average expectation. And we've got looming recessions coming up, as I say, the key thing here is the types of portfolios that you're invested into, and they are managed according to market conditions. So we do expect, and we have seen over 2022 that these fund managers have added value by effectively managing the risk of the portfolio and avoiding the extent of losses that many other funds felt over that time period. There is a little section about us, but I think we gave a good intro for the new people around the table. That's probably something to say, but I'm not going to wave our own flag in this meeting. And that's basically the report. So I'm happy to take questions and also any comments about anything else you'd like to see in the report, either now or maybe if you think of it later, or even where certain things of the investment portfolio have arrived from.
Thank you, Peter. Very comprehensive. Are there any questions or comments from anybody around the table?
I'd only make a comment. I want to say thank you, Peter, for the report. Very, very entertaining, very certainly insightful. I think, if we were looking today, I don't want to put you on the spot, but given that there may be another $2 million worth of investment, keen to just get you to turn your mind to at some stage where we might be doing that next, and to potentially give the investment committee a bit of a steer on that as that may be coming to the committee in the near future.
Okay, we will do that, and we definitely have a view, but we'll put it on paper for the next meeting.
Yep, absolutely. Okay,
thank you. Kelly, did you have anything you wanted to?
No.
add?
Thank you.
Well, thank you, Peter. Yeah, as Jeff said, it's extremely comprehensive. For some of us, it's getting our heads around the terminology and reading the graphs so that we get a picture, and we can communicate back to council, not just that the funds that are invested are secure, but also how to read them and how to make sure that we maintain our objective going forward. So I appreciate.
Oh, that's right. Our industry is full of jargon, like most industries are. So we do actually have, if you go to your statement of investment policy and objectives of SIPO, it does have a glossary in there for some of the terms. But if there's anything in this report, just sing out, and happy to talk through any one of them. Even if we want to have a session in terms of demystifying the investment jargon, happy to do that as well.
Yeah, well, Councillor Lawrence around our table, he's from your world in a different light. So it's good to have his experiences and contribution as well.
10 years ago.
Oh, 10 years, that's not much.
Like riding a bike.
Yeah, exactly.
Yeah, exactly. Yeah.
Your Worship, have you got anything?
No, I'm very good with it. I've enjoyed reading the report.
Well, that's good. All right, well, let's come back to the report, investment update report. If there's no further questions or comments on the report, we've got a recommendation on page 9, 2 parts. One, that we receive the report, and secondly, agrees to consider up to $2 million of further investment in managed funds at the May Investment Committee meeting. The only question I had around that was, is that normal to signal, or is it our expectation that this committee will signal that type of future investment at this point? I know that that's our next meeting, but do we know enough to be able to be saying that now?
I think all it's saying is that you're not making a decision right now at this point in time, while some more work is done, and then it will be brought back to that committee meeting. I mean, it's probably not entirely needed in resolution, but it's a
But for transparency, we're signalling that there is an intention of somewhere around that money to be
consider.
Yeah, to be considering.
Which may be a yes or a no.
That's right.
Correct. And I guess what I'd like the committee to note is it was the previous council that made the commitment for the $5 million total fund, and that 3 million of that has been invested and 2 million has not. And so we're just making sure that the new council, noting that there is another $2 million commitment previously made by the council, so that it has been approved to make that investment.
Yeah.
But we just want to make sure that the investment committee also on board
Yeah.
with that
Yeah.
decision.
Yeah.
All right, well, thank you for that. Okay, we have a recommendation. I'm happy to take them both at once, and I'm happy to move the recommendations 1 and 2. Do I have a seconder?
Yep, I'll second that.
Thank you, councillor Newman. All those in favour, please say aye.
Aye.
Against? Carried. Thank you, everybody, and particularly Peter, thank you very much for your contribution, not just today, but also in supporting the establishment of the investment committee. And yeah, look forward to learning more about the process and watching our small but significant fund growing.
It's been a pleasure, and yeah, no, thanks for placing your trust in Ericsson's Global, and yeah, really looking forward to watching this this portfolio grow over time.
Mm.
Well, thank you for attending. I know it was short notice, Peter. I really do appreciate it.
Okay, with
Yeah,
that,
not a problem. Okay.
with that, we'll call the meeting closed.
Can I
and
just,
it's
I just wonder if we should, I don't know if it's a job of this committee at all, but we should give some consideration to the significant amounts of money we have at call relative to what would now be, even on 30 to 90 days, pretty significant rates of return. That's something you normally do on your own. Isn't it?
So look, I think it's a really good question. We have, I think the investment report shows about $2 million of money on call. Now, just from a business.
No, it's it's about 8.
Yeah, that was around the timing. So over Christmas we invested, and then in January a whole lot came up.
Right.
So I guess the question was the committee going to decide to invest the $2 million? So we just held off, but
Oh, okay.
as of,
This is 31st of Jan, so
yeah, but yes, that's something that we're quite aware of. We don't want more sitting in our bank account than we need to have, especially given that, as you say, the rates are better now than they have been on term deposits.
So is that a conversation for this committee? Is that sort of BAU management to manage those daily, weekly, monthly, whereas the investment committee is looking more at those longer term, reserve funds and things like that?
Yeah, I mean, it is part of our normal treasury management internally. It is something that that we do need to keep on top of and do intend to report to the committee. So,
Okay.
I mean, happy to take your feedback, but it's probably the detail of that I don't think the committee needs to be over. But
Certainly the principles of what we're doing in terms of managing those investments and how we're managing them and where we're putting them, I think is certainly something that needs to come up to the investment committee. And also your question around, why are you keeping 8 million in cash in your bank? Because I wouldn't do that personally. Very good question. I think the more transparency we have around these sorts of things, the better for governors and for our community, because it is.
So should that be a regular agenda item, just up?
It'll be in Kelly's report.
Okay.
Yeah.
And
we'll report on the position of all of our investments.
Yeah.
Not just the managed funds.
Yeah, okay, thanks. Happy with that, councillor Lawson? Okay, well, I'll draw the meeting to close and thank you everybody for your contribution. I'll close with a karakia whakamutanga. E te atua, tēnā koe mō ngā paenga o tēnei rā, āmene. Thank you, everybody.
thank you, Peter.
Thank you.
Thanks, everybody. Bye.
Bye now.
Bye.